The roller coaster of the stock market. What it means if you do not invest if the stock market is going up or down. Most people think, it's not my problem. But what if I told you that the ups and downs of the market are shaping your financial future, even though you've never invested a penny? In this video, you'll find out exactly why market swings affect you, how inaction costs more than you think. Today, we dive into a question that most people don't. The answer is a big yes. And today you will find out why, and the simple steps to protect and grow your money. So, buckle up. That's about to change how you think about your money. If you're new here, we've broken down complex financial topics into smart and simple steps. Let's explore the impacts of the real world, what experts like Warren Buffett and Morgan Housel say, and how even beginners can get started safely. Why stock market swings matter even if you don't invest. Stock movements affect your job stability, mortgage rates, inflation, and even rent prices. When stocks fall, companies usually cut costs, leading to layoffs or slower hiring. Market crises trigger consumer fear, which affects spending and can lead to recessions. Booming markets increase 401 balances, boost investor confidence, and stabilize long-term interest rates. You may not care about the market, but the market cares about you. Chapter 2. The hidden cost of staying out. Inflation quietly eats your money. Money that is not invested loses purchasing power year after year. Historically, the stock market offers an average return of 7 to 10% per year. According to Warren Buffett, the best investment you can make is in the S&P 500 index. Consistently, over time. Morgan Housel notes that waiting for the perfect time to invest is just another form of gambling. In savings, after 10 years with 0% return, loses 25 to 30% in value due to inflation. $10,000 in a S&P 500. It could become $19,000. Chapter 3. What the experts say. Ray Dalio. If you don't own a share of the market, you're betting against long-term growth in the economy. Warren Buffett. Be afraid when others are greedy, and greedy when others are fearful. Morgan Housel. Market time is better than market time, always. Vicky Robin. Every dollar is a vote for the life you want. Invest wisely. How market volatility can be your ally. Volatility creates buying opportunities. Smart investors use falls to get in. The average cost in dollars mitigates risk over time. Indexed funds reduce the risk exposure of individual stocks, letting you drive long-term growth. You don't need to pick winners. You need to stay consistent. How to start investing. Open a low-fee brokerage account. Start with an index ETF. Automate monthly contributions. Ignore the noise. Focus on long-term goals. Compound interest is the eighth wonder of the world. Einstein case study. Two friends. 20 years later. Mike kept the money in a savings account. Sarah invested $100 a month in a low-cost index fund. After 20 years, Mike's account equals $24,000. Sarah's equals $65,000. The mistakes that cost thousands. Waiting for the right time to invest. Trying to time the market. Keep all money in savings just to be safe. Ignoring the high-rate mutual funds fees can eat up your winnings. Falling into hype. Market movements are important, even if you don't trade stocks. Inflation is a silent thief. Investing early, even in small amounts, is better than waiting. Check out the description below tools that will help you. Experts recommend investing in low-cost indices instead of speculation. If this has opened your eyes, like, share and write on the channel, and you're like, we're here to help you take control of your money. Ready to get started. What is stopping you from investing? Let's discuss. Don't forget to activate the notifications. New content comes out every week.